So what happens if you save money in a 529 plan and then your kid doesn't go to college, or if they get a scholarship? So first, know that 529 plan money is not just for college. It's for any post-secondary education and training, so that also covers the vast majority of vocational and trade schools. Second, know that it's super easy to transfer 529 plan money between family members. In fact, the IRS publishes a list of 9 categories of family members to whom you can move 529 plan money without incurring any taxes or penalties. And it's really broad. It even includes first cousins and any future grandchildren you might have. So very flexible. Let's use an example. Say you've got 2 kids. One wants to become an auto mechanic and completes a 2-year program that's very affordable, and you've got money left over in the 529 plan. Say they're well set up in life. You assume that they're not going to need that money ever. At the same time, your other kid has chosen to get an MD, PhD, so you've got loads of higher education expenses. You can very easily move the money from one child to the other to pay for those educational expenses, which is great. But say none of that applies to you, and you're sitting there just saying, look, I really just want to take all this money out and move on. What happens then? So we're going to talk about what happens at the federal level, and then I'll come back to what happens with state. So for federal taxes, what's going to happen, and I'll use an example here, is that you're going to pay income tax on the gains and a penalty. So what does that mean? In our example, let's say that you saved up $20,000 in contributions, and over time that $20,000 of contributions grew into $50,000 total, meaning you had investment gains of $30,000. Now, assume that you choose to pull all the money out at once. What happens? So the $20,000 is going to come back to you free and clear. No penalty, no taxes, which is great. Now on that 30 of investment gains, you're going to declare that as income, and 2 things will happen if you're just pulling the money out, not talking about a scholarship here. You're going to pull out that money, and on the $30,000, you'll declare it as income and pay income tax on it, and an additional 10% penalty. Note that you do get bumped from capital gains, which you would have paid in a regular brokerage account, to income tax, which you're paying because it's coming out of a 529 plan. But still, not the worst penalty in the world. Actually pretty reasonable, because clearly they're trying to encourage us to use 529 plans for education expenses. So there has to be some penalty if you don't do that, but it's not the worst penalty in the world. Now, let's say instead that we're talking about a scholarship. Something pretty similar happens, except you avoid the penalty. You basically just have to pay the income tax that you had previously avoided by putting the money in a 529 plan, but you don't pay the penalty. Important note though, you can only use that rule for the amount of the scholarship. So if the kid received a $10,000 scholarship and you're comparing that $10,000 to your $50,000 account balance, you can only avoid the 10% penalty on the amount equal to that $10,000 scholarship, not on the full account balance. So let's talk about what happens with state. With state, this can get complicated and it varies by state, so we highly recommend working with a qualified tax professional if this is your situation, or if you're DIY, really getting in the weeds and making sure you understand how to do this right. It's going to vary by state, but know that broadly, many states will look to take back some of the benefit they previously gave you, some or all of the benefit they previously gave you from you using a 529 plan and then not using it for the intended purpose. So this can be things like looking to get the taxes, the state taxes that you previously avoided by putting the money into a 529 plan, looking to even take back some of the deductions you might have taken previously if you're in a state that gives a state tax deduction. Again, it's very state specific, and if this is your situation, you want to really make sure that you get that right.